Welcome back to John Orther's Note. There has been some good news out of the eurozone this week. Fitch, the rating agency, increased modestly its rating of Ireland, one of the smaller eurozone countries. It wasn't a big increase, but it was the first since the start of the eurozone crisis in 2009. With me to discuss the cheer we're getting from Ireland is Julian Callow, the European economist at Barclays. Thank you, Julian. If we look at our first chart that you brought along today, we see something quite remarkable that's been going on in Ireland over the last few years. What are we showing here?
Oh, here we're looking at the real effective exchange rates, Ralph. Now, this is a measure of competitiveness. It's effectively the exchange rate, but it's adjusted for inflation measures, in this case for manufacturing unit labour costs, which is really the critical factor. And when it's going down, the country is gaining competitiveness, and you can see in the last 3 years, we've actually had a very strong depreciation. Since the crisis, you know?
Yes,
really since the crisis. And that is, I think, a very encouraging sign about the flexibility of the Irish economy. And it's generated, in fact, significant current account numbers. Ireland's getting a significant current account surplus this year.
Generating growth in Ireland?
Well, it's a key factor, really, why Irish GDP is actually just starting to edge up slightly. It's on the back of a very vibrant export sector. And there's an important message here, because I think if you can achieve that degree of competitiveness adjustment within the single currency, then of course the arguments that the currency has to fragment and countries have to leave become much, much less.
It shows Ireland doing obviously much better than the other.
Well, it suggests that for the other countries there will have to be a very significant downward shift in the real effective exchange rate.
What matters, of course, though, is Ireland's public finances. So if we look at our second chart, we've done the, here we have government debt, and Ireland not looking so brilliant on this one.
Well, no. I mean, I think the Irish government would be saying that by 2014 the debt ratio could be just starting to come down slightly.
Just tipping.
Yes, that's very important, really. I think for the financial markets to really want to breathe a lot easier, they are going to want to see that. But that in turn means that you have to generate around 4% nominal GDP growth.
Okay, let's put this in the eurozone context and see how, on a market perspective, I'll bring up our final chart.
Yes.
We have the bond yields, two-year government bond yields, and what we see here is quite the obviously huge spike that we saw in Ireland, but now quite a big improvement. What explains that that fall? Is it just the growth improvement?
Well, I think it's the psychology that says, yes, the Irish situation is sustainable here, even though it's been in an official programme. The official programme has been working. I think the IMF and certainly the European Commission and Eurogroup want to really make Ireland the poster child for success, how these official programmes can work.
The significant thing about Ireland, though, of course, is that Ireland bailed out its banks. And if we compare it with Iceland, a little bit to the north, Iceland let its banks collapse. Which was the better model? Can we read anything out of Ireland's example?
Well, I think the problems fundamentally in Iceland were just so much greater. In fact, if you look at the overall indebtedness of the country and the problems that the banking sector had. There is a very interesting parallel, though, which is both Iceland and Ireland have had a very significant depreciation in their real effective exchange rate. And that in turn has generated exports, and that has helped to generate economic growth, and that is making the task of fiscal consolidation, which I would emphasize is still a long way to go for both countries, much easier to achieve.
The final question, I suppose, is whether that Irish bond yield has to come down further before Ireland can enter the market.
Well, I think, again, we are likely probably to see some further downwards movement there. I mean, certainly this is a 2-year. And
we should mention, of course, the ECB's role in
quite low. And exactly, with regard to the ECB, it has stated that as countries are returning to market, then it is ready to activate the OMT programme, by which it would actually be buying government debt on a potentially unlimited outright basis. And this certainly could be another supportive factor for Ireland here. Now, that ECB activation does require, I think, first of all, it to be used in the case of Spain, and then Ireland could be following suit there.
Julian Callow, thank you very much. So a little bit of an optimistic story from the western fringe of the eurozone there, but still a lot to be done, I think, before Ireland can return fully to the markets.